We'll continue on here with the broader markets. Let's bring in Torsten Slok. He is Apollo Global Management Chief Economist, joins us here at Post Night. Great to see you, Torsten. So the market had gotten pretty comfortable, right, with this idea that the interplay of U.S. economic growth, what the Fed's going to do, the tariff situation being somewhat settled. How do you see this little jolt from Friday and whether it continues?
Well, I think this feeds into the broader narrative that we have already for a while now talked about the K-shaped outlook for the consumer. Some consumers are doing well, some are doing less well. Now we're also having a K-shape for the broader economy where you have a booming industrial renaissance, but the consumer is facing more headwinds, because of this little bump on the road, with suddenly now imports from China becoming more expensive. That's a headwind, as Sarah just was mentioning, to a number of the retailers. At the same time, affordability is also being an issue for some consumers. There's more talk about subprime auto loans becoming a slightly bigger issue, of course, in the market, especially in securitized pools of auto loans. So the key issue here is if we now have a situation where the booming industrial renaissance is doing well, data center build-out is going great, energy is also going great, you also have, broadly speaking, infrastructure, defense also going great. But on the consumer side, there's now more headwinds. So this China news that we had in the last few days is just a slight headwind to the outlook for the consumer, because now we just have the risk of more upside pressure on prices and therefore some more headwinds to the consumer outlook.
It seems like the market has been struggling with two kind of divergences. So one is very soft labor market, but GDP still tracking because of the CapEx move that you see right there. The other one is public corporate credit spreads have been very benign, and yet you're seeing these little eruptions out of the kind of the fringes of the credit space. You mentioned auto loans, but obviously also some of this kind of private credit hiccups. So where do we sit with those things? Does that just mean we have to wait and see how it all plays out?
Well, this is why this issue of why is job growth slow? Well, we don't have job growth at the moment, but why has job growth been slow going into the shutdown?
Yeah.
Is it simply because of less immigration? Because if there's less immigration, then for the Fed, that doesn't mean anything. They should just say, well, there's less immigration, but that doesn't mean the economy is slowing down.
Yeah.
Or is it because there is a slowdown going on where the economy is slowing rapidly and therefore labor demand is weaker? So the key question here becomes for the Fed, especially going into the meeting here in 2 or 3 weeks' time, is exactly this issue. Is the slowdown in the labor market because of slower supply, or is the slowdown because of lower demand? And if it is simply lower supply, border encounters are basically zero. And I think that there is a much more likely story that this is not driven so much by a slowdown in the economy. You still have strong growth when it comes to Red Book, same-store retail sales. The weekly data we get is still strong. The daily data for how many people go to restaurants from Open Table is still strong. You also have weekly data from staff or hotel demand. It's also very strong, both for consumers and for businesses across the country. So it is exactly as you're saying, Mike, very inconsistent that the labor market is slowing. But why is it consumption, CapEx spending in particular, is still so strong? And that suggests that it is actually still the case that GDP and the economy is actually doing still well.
So do you think it would be a mistake for the Fed to cut in the October meeting, which it looks pretty likely that they're going to do?
Because the risks are now rising that if they do cut simply because of a slowing in immigration, that we might simply have even more lift in inflation, because now there's more lift in inflation coming because of tariffs. There's also lift in inflation because of the weaker dollar. So as a result of that, if inflation is going up and we now start cutting too much, that of course raises the risk that the Fed should not be talking about rate cuts. They should maybe even be talking about rate hikes.
But you've been warning about inflation for a while, and we haven't really seen that much inflation.
Well, you had in the last earnings season, it was also Friday, several of the retailers are talking about the impact of tariffs. They're talking about how to deal with it. It's having an impact on their cost side, but it's certainly also having an impact on how to think about pricing.
I wonder, though, Sarah mentioned the bond market's closed today, but if we were pricing in more cuts, as the market has done, if there was really a concern about that being a mistake and it's going to create this inflationary flare-up, wouldn't long yields be going up, not down?
Well, that's why long yields, in some sense, have been drinking the Kool-Aid here and said, oh, the next move from the dot plot is saying rates are going lower. But the issue is here, of course, are we going to see a repeat of 2022, where, of course, stocks went down and rates went up because there was more inflation in the pipeline? So that's why the consensus today has the view that inflation over the next 12 months will be 3%. That is drastically higher than the Fed's 2% target. Yeah. So if now we have further upside pressure on inflation coming from potentially more tariffs, and at the same time the dollar also going down has been putting lift on inflation, it does raise a lot of risk that maybe the Fed should not be cutting more. And this is what I think is most important in this market, namely that the biggest underappreciated risk is that we are simply not done fighting inflation.
If that is the case, then where's the 2-year yield? 3.5%. I mean, shouldn't that be tracking where the Fed funds is, which is now much higher than that?
But the dot plot is, of course, telling us all rates are going down, so the market is expecting that rates will go down. But this is the question. Are rates going down simply because inflation will be coming down? Or maybe the risk is that inflation is not coming down, especially with new shocks, such as upward pressure on tariffs on inflation, and again, the dollar that is in the pipeline.
And where do you place the explanation for what's going on with gold? Okay, so it's disengaged from really inflation, from real yields. It seems like a momentum play. Obviously, even the dollar has bounced with gold making new records.
Well, I think there are three reasons why gold is going up. First of all, the inflation risks are still here. There's still a lot of risks for the tails to play out in one way or another, given everything that's going on, especially again now with the trade war coming back. The second reason why gold is going up is because Chinese households in the ETF data are buying significant amounts of gold. And you also see on the sanctions side, central banks globally are still divesting from U.S. treasuries and buying gold instead. So those three tailwinds have continued to provide very strong growth in gold prices, and we should expect that to continue.
So those are going to be price insensitive, kind of buyers in there. In other words, they're going to keep 4,100 an ounce. We're going to keep buying.
I think some of them will be the central banks because of sanctions. They're definitely price insensitive, and I think also a lot of the demand from China has likely also been price insensitive because Chinese households can really only buy two things, namely apartments and housing and stock prices. They don't have the option of buying U.S. equities the same way that we have here in the U.S. and Europe. So because of that, they have been diversifying away from their traditional investments more towards buying gold. The ETF demand in Chinese gold has been very, very strong in China.
It was weird to see the stock market sell off so much Friday and then gold sell off, right? It wasn't a safe haven, and now it's rebounding with the Nasdaq.
Yeah, absolutely.
Yeah, I know.
So Bitcoin too. All right, Torsten, great to see you. Thank you.